Welcome, everyone, to the second and final video series of Schneider Downs Wealth Management's coverage of the private markets, titled Traditional to Seed and Everything in Between. Joining me is my colleague, Matt Biggs. My name is Jason Staley. I'm the Chief Investment Officer of the firm. Matt covers private equity in addition to some other private markets for us. Matt, welcome.
Yes, excited to do another video here to close out 2024, and looking forward to more and more of this throughout 2025.
Yeah, I think we're really excited. We launched two private markets webcasts, webinars, kind of whatever they're calling it these days. But this one, Traditional Seed and Everything in Between, covers traditional private equity, seed being kind of venture capital, and then kind of everything in between as private markets continue to evolve. And then our sister webcast is called Hard Hats, Shovels, and Lunch Pails. It takes a look into real assets, things like infrastructure and real estate, farmland, timberland, kind of a different part of private markets, but certainly germane to the overall asset class of private markets and alternative investments. And we're really excited for 2025 and to have launched these in 2024, which is going to give a nice little ramp up to what we expect to be a better market in 2025 as we get a little bit further away from 2022, from the spike in inflation that really kind of roiled markets. So I think today we're going to talk. We're going to give you a high-level summary of some of the fundraising that's gone on in private markets. Talk about some specific deals, and then trends that we're seeing in the market, and what we think might happen in 2025. And I think I want to spend a little bit of time talking about why we think private markets are set to do well in 2025. As almost everyone here knows, we had an election in November, and thankfully, when we sit down and we watch football or college basketball, or in the case of here in Pennsylvania, we're home to two of the top four women's volleyball teams in the country, with our hometown Pitt Panthers and the Penn State Nittany Lions. We're able to watch these games with our family and not be completely hijacked by political ads. But I think the election was important in that it provided some clarity on the direction of where private markets, and then just kind of markets in general, are likely going to trend, with President Trump and then incoming Vice President Vance coming in. They've laid out an economic agenda that they still have to execute on, but is very much kind of pro-business and pro-American business. And they're talking about focusing on lowering the barriers to M&A, creating higher economic growth, which the hope is if you get kind of that 3% GDP growth target, you're going to get more investment coming in here. You're starting to see the chairman of SoftBank, Masayoshi Son, come over here and pledge 100,000 new AI jobs and tens of billions of dollars of investment. So obviously we have to see follow through there, right? These are very much policy declarations, not necessarily hard policies that we're going to see come in. But I think that what at least from the conversations we're having, Matt, it seems to be that there's some renewed confidence, that there's some cash on the sidelines that companies were sitting on that are likely going to be deployed. They have, the tax environment looks to be a little bit more clear. Certainly kind of some pro-business aspects to it, and I think that's the bar that the incoming administration set for themselves, and they've got to clear it. And it's a high bar, but it's a bar that clearly you're starting to see some enthusiasm. And I think from that enthusiasm, a lot of it revolves around the U.S. being the dominant player in AI. And I know, Matt, you wanted to spend some time talking a little bit about that.
Yeah, and I know that this is something that you and Sean will probably touch on a little bit in the other video series, but I do think it's important to point out, look, public market's been a great pretty great year. S&P as of today up 26%. We've continued to see large cap growth do well. NVIDIA is probably the best example when we talk about AI, and it's the name that most people associate with AI when we're talking publicly traded companies. And NVIDIA is up 172% year to date. I just thought it would be a good idea for us to briefly talk about, what our approach is in the AI boom, and specifically from a private market standpoint, Jason. And since you do the other podcast, closely focused on that, wanted to hear your thoughts on kind of what our take and what our approach is, and how we are still kind of indirectly investing in AI.
Yeah, I think you have, the first leg of this innovation you saw, or kind of the market return that's realized by investors, happened in the public markets. You had NVIDIA, Microsoft has very well publicized ownership interest in OpenAI, which has the ChatGPT that I think everybody has probably played around with at least once or twice. If you haven't, I think that you should do it. We'll put something in the show notes where you can. There's a link to kind of the beta version, but it's truly remarkable what they're able to do, with that program. And I know they're trying to create enterprise versions that they can license, and they went through. They went through the process of kind of converting to a for-profit entity and a lot of that. But that was the first leg of trade. The NVIDIAs, the Microsoft. You're seeing a very big run-up in Broadcom over the last 2 weeks. So kind of that's the public leg that I think everybody is aware of. Like all things, there's a way to look at this holistically. And I think the first thing that comes to mind is that it takes a great deal of energy to create the environment where these large language models can come through and do all the processing that allows AI to be the powerful tool and kind of generate the promise, right, of what it could be. And so we look at that and we think that there's a lot of infrastructure in this country that's going to need to be built. And there's from a energy perspective, right? I think that's what you alluded to on the real asset side. There's a clear need for an all of the above and then some approach. We are, 3 Mile Island, the infamous 3 Mile Island is getting recommissioned. They're going to try to bring that on. You're seeing Google and Microsoft try to create mini nuclear reactors to power, some of their data centers. You're seeing the resurgence, quite frankly, of the need for natural gas and the need to have, renewable resources, hydro power, solar power, wind power. There's the promise of AI can only be fulfilled if we have the energy and the talent here in the United States to harness it. So there's that energy component that we're very excited about from an infrastructure perspective. And then on the private market side, there are these businesses that you wouldn't necessarily think are in the AI supply chain, but they are the small industrial manufacturing business that creates component parts to transmission lines. The people that are building some software, not the ChatGPTs of the world, the OpenAIs, but people that are creating at the lower levels, software to help implement this. And so that brings in the venture capital, and why venture capital has been a 4-letter word for the last 2+ years, because you've had no distributions. You've had a lot of companies that had a valuation of X, and now they're valued at Y, and that delta between the 2021 mark and where we are now is significantly lower. When you look forward and you fast forward, though, there's an opportunity. Venture capital people have pulled back allocations. The innovation hasn't stopped. Just the capital hasn't come into the asset class nearly as much as it was, kind of coming out of 2020, 2019, 2020, and 2021. And we're going to throw up a few charts here provided from our friends at JP Morgan Asset Management that show you kind of where fundraising sits and what we're excited about. But I think AI a more holistic view of AI outside of these publicly listed stocks, there's a massive opportunity there.
Yeah, and I think a couple of things you said in there lead us into that fundraising piece, right? Where 2021 was kind of a historic year from not just fundraising, but also the exits and just the amount of deal volume happening. And that was because of the low interest rate environment. And I think now it's, fast forward to 24, and you can see that on this chart, year to date November, we're at about $1 trillion in global private capital fundraising versus, to your point earlier, Jason, 2021, almost 1.8 trillion. So
and the level of fundraising is kind of in between where we were in 2015 and 2016, which is, I think that there is there was a lot of fundraising that happened, and I don't want to say that all of it was spent and invested on bad companies, right? Or these general partners in any way, shape, or form, made mistakes. Mistakes happen through all years, all vintages, all cycles. But what we want to show here is that there's been a retracement in fundraising. So if that in and of itself is kind of a way of showing demand, but also kind of the commitments that were made in previous vintages. And you can look here, kind of the largest being kind of traditional private equity in the purple, venture capital. If you look at these right here in 21 and 22, you can see that dark green box. There's a lot there. A lot of fundraising happened, and then you come down into 2024, and you can see not as much private credit. I think that has been a boom. A lot of people are raising money because of some of the changes that have gone on at banks. Our hometown PNC is kind of their tagline is brilliantly boring since 1865, which is great for their business. But the private credit, someone is going to have to lend into these markets, and banks are being a much more conservative. And so moving forward, right, you're seeing some of this rise of private credit where maybe PNC syndicates a loan, creates a loan, and then sells it into the private markets, private credit. Real estate, again, kind of as private credit has gone up, real estate, which we touch on in our sister podcast, Hard Hats, Shovels, and Lunch Pails. Private real estate fundraising has been down. I think we've touched quite a bit on that. Infrastructure has been pretty consistent, and then natural resources, you can't even see it because very few. There's not a lot of money going into that. That kind of goes back to the original thing, the original comment around AI and why we're so excited for that particular opportunity set, right? Which is you're going to need an all of the above solution. Natural resources are going to be a part of it. And I think that's an exciting investment theme for 2025 and beyond. So if, there's been material slowdown, right, in private equity, but you look at this next chart again, by our friends over at JP Morgan Asset Management, you can see there's a lot of dry powder by asset classes that are out there, which is, I think the if you talk to private market participants, one of the things that they are excited about in 2025, again, is the policy, words have to become policy, right? You have to take campaign promises and make them into solutions. But the incoming administration has certainly generated a lot of confidence among CEOs when you look at those surveys, whether that's confidence about a regulatory regime, the tax regime, or just the overall economic growth picture. CEOs are very excited. I think private market participants are excited about what that could unlock. There's a lot of cash sitting on the sidelines. So if you're allocating to capital, one of the things as a private market investor that's been somewhat difficult has been you haven't been getting a lot of distributions. So you had a lot of money going out, right? You go back to that last chart, a lot of capital commitments, money going out. Okay, am I getting any of it back? And while public markets have really healed, right, and they've come off the 2022 lows, And in 23 was a great year for equities. 24 is shaping up to be, a very good year for equities. The private markets recovery has been slower, and it really won't manifest itself until you start to get the distributions coming out. And I think that's the push-pull that we see, right, Matt?
Yeah, and I think when we look at that previous chart, it kind of feeds into this, but that's, the first thing I think of this year is, we've had a handful of pretty robust years of fundraising, and really that's one of the reasons why it's slower this year. But to your point, I think it's also the lack of distributions. And if we go back to that next slide, we start to see some of this dry powder come off the table and start to get put to work. Hypothetically, we're going to start to see distributions kick up, and then a lot of that capital is just going to keep getting recycled back into private markets. So there is this push and pull, but it's all kind of tied together in a bow. And it's just Jason, maybe that's a good lead into, okay, this is kind of the environment that we're in right now. What are we expecting? Do we expect that to change? What is the 2025 outlook looking like for, moving forward?
Yeah. And I think that it's like everything, it's not going to be a straight line. It is, but you look at, the dry powder that's out there that's going to have to get invested. I think businesses are kind of in a position where if they had a number in their head and they thought, hey, maybe that number gets better because interest rates are going to come down, access to debt. Well, the Fed cut 25 basis points and kind of said, hey, we might be on pause moving forward. So I think there's going to be some price certainty where you're not going to be maybe holding out hope for, for a better price to come along. And I just think the confidence, if you're going to buy a company and you want to build it, if you're building a platform and you want to buy, the main component, the main central part of your business plan, and then go buy $3 to $4 million of EBITDA and tuck it back in, you've got to be pretty confident about where economic growth is for you to make those investments. And I think that's where, you could see, I certainly expect, if there's follow through on the policy perspective, I would expect then to see, more robust capital market activity. And I think it's a good time to be an allocator in the private markets, because you have public markets that have enjoyed a really great run, and valuations. We're not going to talk about public market valuations here. Everybody, I'm sure that's watching this has seen, talk about where the Mag 7 are trading and where the S&P 500 is and growth versus value spreads. But I still think kind of the old adage that Benjamin Graham, pioneered, which is kind of, the idea of buying a business at a good price, being able to buy low and sell high. Well, the markets are pretty expensive in the public side. They could still go up. But I think one thing that we're seeing is on the private market side is that you can buy a really good lower middle market business for 7 times, or you can buy a kind of a true middle market business for 11 times. That's not to say that the valuation that you buy into is necessarily going to lead to a better profit. But what I do think it does, it gives you the opportunity, right? If you're looking for an area to deploy capital or commit capital to where prices seem to be a bit more reasonable, the private markets look pretty attractive. And so I would say that's our outlook, in that is that we would expect it to be a little bit, kind of a better, more attractive environment. And you started to see, I think, some of that come through, where you did see some pretty notable, exits and investments. Blackstone and Vista Equity, Smartsheet was a software company, and that was an $8.4 billion deal.
The DirecTV one, that was the one that stood out to me. Yeah,
DirecTV. I'm trying to think of TBG. TBG bought DirecTV.
TBG was DirecTV. Yeah.
And so I think that there's certainly, you're starting to see that kind of come in. I would say on the international side, the one thing that you haven't seen is a whole lot of deal flow there. Obviously, the prices are a little bit lower. I think that's, from a purchase price, to enterprise value to EBITDA, which is kind of the price to earnings of a ratio of the private market. It's been pretty consistent over the last 2 years. I think 2023 was, right around, maybe a little bit less than 11 times. Where we are right now is maybe a little bit more than 11 times. But, I think that whether it's debt to EBITDA, EBITDA to kind of cash interest, kind of all of those metrics that are used in the private markets, things have relatively stayed the same in private markets versus that public markets that's really moved up. That's where we think that there's some real opportunity. And going to throw up another slide up here on the opportunity side, Matt, to kind of tee you up to talk about where we're seeing from an exit environment perspective what the opportunity is. And we're just going to throw up a chart here that talks about IPO deal value.
Yeah, I think IPOs specifically, we think about public market sentiment, right? So tough to do an IPO when markets are selling off, right? That's not necessarily the best time to roll out an IPO. That said, public market sentiment's been good this year, and I think we would anticipate, if you look at the chart here, you can see Q1 and Q2 relatively active. Now you go to 20 through 2022 and the end of 21, and it kind of a little bit of a spike there, right. Normalized a bit, and then now we did see activity pick up in Q1 and Q2. What I would say is the PE-backed IPOs for 2024 so far have done pretty well. I believe as of the end of November, those IPOs were up around 20%. The venture-backed or the venture capital-backed not fared as well year to date, and those to the point where the last I saw was at a loss of around 6.5% to 7%. Yeah. So, I do think though the positive of the PE back being up 20%, I would expect us to see more IPOs from a percentage standpoint as an exit going into 2025, assuming we can keep that strong kind of public market sentiment.
And I think that's kind of, look, I don't think anybody, we would certainly, and even, the general partners, whether they were VCs or just the private equity back, what happened in 2020 and 2021 and the beginning part of 2022 was so clearly an aberration into kind of the activity. People were so excited, right? Because you're coming out of a pandemic and everybody thinks the world's going to dramatically change. Well, that didn't really come to fruition the way that I think that some people would have thought. And you had kind of deal volume kind of fall off a cliff. And I think that's one of the, if you're asking, well, what are some private market participants excited about? And what are we hopeful for? We're hopeful that we do get that 3% GDP growth. We are hopeful that, the business view the FTC, the Federal Trade Commission, as overly hostile to M&A. And so they held back because they didn't want to get in a tie-up with a company and then have to pay a breakup fee if it doesn't pass the FTC's muster. Worried about kind of where taxes were going. There are all of these things that are coming in. Now, that's also to say we've got an administration that's going to come in here and potentially, talking about tariffs. And it's not a perfect scenario at all. But what we do think is that there's a reason to be excited about private markets, both from what you have in the ground, that money that's already working for you, and commitments that you may have made in 23 and 24 and in the beginning part of 25 that are, have a lot of dry powder. Kind of going back to that chart, you've committed capital, but they maybe have only called 35-40% of the fund, being very judicious in the price that they're paying. And I think that's the other story of this, is that GPs are just they're more discerning. They're worried about what they are paying for a business. In the venture world, it was grow at any cost. Just keep putting up all of that growth. Versus, the the model that they're in right now, which is we want you to grow, but you got to show a pathway. You have to be able to show this pathway to profitability. And so I think kind of ending this conversation, Matt, I think what we saw was a lot of 2024 was a year where there were more sponsor-backed M&A activity than corporate, right? So that's private equity, to your point earlier, private equity coming in and buying a business versus looking outside my window, PNC going and buying a business, right? You saw more sponsor-backed activity. It would be very interesting to see if that continues, or you get the corporates kind of coming back, have a little bit more confidence in it, and then all of a sudden they've got something going where you're getting more activity moving in. I think IPO volume, it shouldn't return back to where 2020 and 2021 is, but we need it to get back up, both from it's a good measure of where the sentiment is of the investors, but also getting distributions back into the pockets of limited partners. And then I think this idea of holistically investing in AI. I think that's something that we're going to be talking about in every one of these iterations moving forward. It's just that the view of there's so much investment that needs to be made across so many subgenres of this asset class, and there's going to be a lot of ways to hopefully make money for clients and to make investments in really interesting companies. But I think those are the big takeaway highlights.
Yep. Yeah, I'm looking forward to next video here in Q1, maybe Q2 of 25, and hopefully we're coming back reporting some interesting deals over the next handful of months, right?
Yeah, would love to have a webcast that talks a lot about kind of the deals that are coming through and a lot of the high profile. So from Matt, myself, and all the rest of our colleagues at Schneider Downs Wealth Management, we want to wish everybody happy holidays and a very happy new year. We look forward to seeing you all early in 2025. Take care and see you soon.
Thanks, guys.